So, gold and silver. Here we are entering that end of November time frame. Bitcoin, gold, silver, what's going on? Fingers crossed. What was on fire recently? So let's look at a couple things. With starting with Dave Kranzler. Fund manager warns LBMA and Comex gold markets are in a state of collapse. Many will chuckle at the proposition of Western gold market failure and note that the price of gold has gone nowhere. If the markets are in collapse due to lack of available gold, then where's the price action exploding to the upside? The disappearing stock of gold, physical gold, on the COMEX and the LBMA has been documented and discussed by several analysts recently, including this website. This is from Silver Doctors. In correlation with the disappearing physical gold is the preposterous amount of paper gold claims issued against the dwindling supply of gold both in New York and London. But what does it mean, and where is all this gold going? Longtime precious metals market professionals and analyst David Jensen has written a must-read analysis which explains why the explosion in the amount of paper gold and the disappearance of physical gold is transmitting the message that the New York and London bullion markets are in fact collapsing. Many will chuckle at the proposition of Western gold market failure and note that the price of gold has gone nowhere. If the markets are in collapse due to lack of available gold, then where is the price action exploding to the upside? Well, digital gold and silver are available in copious or infinite amounts and continue to trade on both the LBMA and Comex exchanges. You can have as much digital or virtual metal as you want on these digital exchanges. There is no shortage of virtual metal, and thus the virtual price that most investors follow won't move up. The bullion banks have always sold down this virtual gold price when it has risen. The telling of the story is instead in physical gold and silver availability, and the physical availability. And so we look first to the LBMA, the primary global physical exchange. The LBMA indicates in its own market guide that its primary gold trading contracts unallocated spot market contracts, which are claims for spot physical gold ownership right here, right now. Give the holder just an unsecured claim for physical gold. This has allowed the creation and trading of non-existent gold to the point that the London spot physical gold market trades 200% of the global annual gold mine production each day. They trade the annual gold mine production each day. How is that possible? Because they're just trading these pieces of paper. And that's what sets the price of gold and silver. Pieces of paper which are nothing more than bets. And if you own all the bets, because there's no position limits, that rule got taken out a long time ago. They tried to re-implement that rule with the Dodd-Frank Act, which a federally appointed by the president judge said we were going to strike that part out because Congress didn't say why that would actually do anything. So that part, CFTC and CME Group don't have to worry about implementing that. No, don't worry about position limits. So any entity, JP Morgan, HSBC, the club, can buy as many of these paper contracts as they want, which is why just recently, as I've said several times now, the paper contracts to real thing have been 300 to 1. Never, ever, ever before have we seen numbers like that, which means something's going on. Something is absolutely going on. And if it's taking that much more paper to keep a stranglehold on the price, they must be worried about something. Something big, as in a big rising in the price of gold and silver. So they have to try to smash it by buying and creating, just simply creating more of these contracts. They don't have to have any underlying asset, just print more of these things. That's it. Can you imagine being able to do that? That's the equivalent of a company issuing its own shares, and then when it decides all those shares are gone, we're just going to issue some more. We don't have to get any approval. We'll just print them out of thin air and set the price, of course, and just sell them out. So imagine being able to just print as many shares as you wanted as a company, and for each and every share that you print up, you sell off and get the money. Now, the difference here is that the club isn't interested in getting the money. They're only interested in using these paper contracts to sell back and forth to each other. The left hand sells to the right hand. And if they need to crash the market down, they sell a lot at the same time. And there's no other human being out there really buying enough of these things. So the other right hand buys them once it hits the price point they need it to hit. And then, for example, $14.20 silver today and 1,071 gold. They're okay with that. You can watch the volume and everything. You won't see too much action. Price starts rising again, up. This hand now sells back to this hand, which could simply be JP Morgan selling to HSBC or Citigroup or Bank of America or whoever, or as JP Morgan said, their client. They have a client that has this huge short position. Say, JP Morgan, who is this quote unquote client you speak of? Is it the federal government in disguise, maybe? Or just another giant banker conglomerate? So he says you can read the rest of the article here, which he puts a link. It's safehaven.com. But he says, we must not forget that when Germany in 2013 asked for the return of 674 tons of their gold, primarily from the Federal Reserve and some from France, they only received 5 tons. They were then told that they could get the rest back by 2020. They then announced that they actually received around 150 tons back in 2014. Now, that's what they said. And again, that's 150, not 674 that they wanted. But Germany has since stopped repatriating their gold, with Merkel declaring that Germany is happy holding its gold in the United States. It's not a shocker. So then we have gold withdrawals on the Shanghai Gold Exchange are now at a new record high. The only question now is how far will the bullion banks have to stretch the paper game in order to keep the price contained and the interest from the hoi polloi in gold subdued. The insane degree of intervention in the markets reflects sheer desperation by the manipulators to keep the wheels on the system. When the intervention fails, the reaction by the markets will be spectacular to watch. Submitted by, once again, PM Fund Manager Dave Kranzler. For the week ending November 6, gold withdrawals from the Shanghai Exchange were 44.97 tons. This put the year-to-date total withdrawals at 2,210 tons. Gold withdrawals year-to-date from the Shanghai Exchange are running 29% higher than last year and 20% higher than 2013, which was a record year for withdrawals. SMAUGLD.com has compiled an excellent summary of the gold withdrawal statistics on the Shanghai Exchange, plus some data on central bank holdings globally. You can read this here, China and gold. China's consumption of gold this year is on track to exceed the total amount of gold produced this year by mines globally. India is on track to import close to 50% of world gold production this year. Russia adds to its central bank gold holdings every single month. In June alone, it added 800,000 ounces, which is over 23 tons. On the other hand, paper manipulation of all the markets by Western central banks, specifically the S&P 500 and gold by the Federal Reserve, is starting to reach an insane extreme. Today was a prime example of the S&P 500 futures spent most of the overnight sessions starting Sunday evening, down 8 to 12 points. Gold was up $12 most of the day, or most of the night. As the U.S. stock market opened, gold began to get hit, and the S&P 500 popped from down 8 points into the positive territory. This was after extremely negative economic and earning reports after they were released. Then, as far as gold faded back to Friday's closing levels around 1:30 p.m. Eastern, the S&P went parabolic, rising 30 points on absolutely no news. Now, where was I? Someone handed me a little card. Whoa, please put clothes in the dryer. I'm heading to bed. YouTube, got to stand by 1 second. Get back to my place. This is extremely negative economic earnings report released then as gold faded back to Friday's closing levels around 1:30 p.m. The S&P went parabolic, rising 30 points on absolutely no news or reported events that would have possibly triggered a sudden surge like this. Well, I'll tell you what it is. It's what Lindsay Williams said it would be this whole time. The markets are going to pull every last sucker in before they pull the rug out. When you think the markets can't rise, they will rise. When you just know they can't rise any higher, they will rise. Good news, they will rise. Bad news, they will rise. When you think it's finished, they will rise. Prime example. As it also happens on a preliminary basis, it looks like 11,215 gold contracts were added to the Comex futures open interest tally. This is 1.12 million paper ounces, or 74 times more paper gold than the amount of gold reported to be available for delivery on the Comex. The total paper gold to deliverable gold, as reported, is now 290 to 1. Given that, and again, that's the reported numbers in these vaults of all these banks that have their little, bullion vaults that deal with the Comex that they can store for customers as well as send off for the Comex if anyone demands delivery. JP Morgan, Scotia, there's a few others. 290 to 1. Then I've said this about 400 times now. About 2 years ago, the COT reports, which is what he's talking about, just based off of the numbers they're giving us, the ratio is 290 to 1 right now. But it says a little disclaimer. The information on this report is believed to be true and from a reliable source. But if it's not true, don't hold us accountable. So if we as in they, the club, is on fumes as far as physical metals go, and they're showing that they have a certain amount, and it's still right here, 74 times more paper gold than the amount of gold reported to be available for delivery on Comex. It's 74 times more than that. That's how many more paper contracts are out there than what's supposed to be deliverable, what is there for delivery. And that's with the disclaimer of the information we get from this report is believed to be true from a reliable source. So if it's not, and you know it's not, is it really 74 more times? Are they so much on fumes that it's hundreds more times? Or more, maybe thousands more times? There's no telling. The total paper gold to deliverable gold, again, is 290 to 1. Given that the appetite for gold from the East exceeds the amount of gold produced to feed that appetite on a hand-to-mouth basis, we can only speculate as to the sources being tapped by the Bank of International Settlements, the Fed, Bank of England, ECB, to feed the gold-consuming beast. What I will say with 100% certainty is that if you want to own gold, but do not have possession of it, or at least have it safe kept with an extremely trustworthy custodian, you will probably never have a chance to hold that gold in your hand. It is gone, and if it's not gone by now, it will be gone by the time you understand the reason or reasons why it is gone. The only question now in my mind is how far will the bullion banks have to stretch the paper game in order to keep the price contained and the interest from the hoi polloi and gold subdued? Or is that hoi polloi? If the entities holding the long positions in Comex paper do not hold the paper short sellers accountable, what's to stop them from taking that 290 to 1 to 500 to 1 if they have to? The insane degree of intervention in the markets reflects sheer desperation by the manipulators to keep the wheels on the system. When the intervention fails, the reaction by the markets will be absolutely spectacular to watch. And again, I'm going to add, where's the Comex located? Who runs it? It's located in Chicago. Chicago Mercantile Exchange runs it. So, you don't suppose a bad boogeyman terrorist might do something in Chicago and cause the CME group to stop functioning somehow for some reason, do you? Been hearing a lot of news about Chicago lately as I've been covering in my videos. But that's conspiracy talk. That would never happen. Except it did happen on 9/11. I'll let you figure that one out. Take care.